Imagine, imagine issuing this multi-million-dollar commercial loan, watching your borrower go totally broke for closing on their massive property,
Yeah.
and then suddenly realizing you are now the accidental landlord to the biggest AI company in the world.
I mean, it really is the ultimate plot twist in modern finance. You start the year just trying to collect regular interest payments, and you end it holding the literal keys to the physical real estate that's like shaping our entire future economy.
Yeah, it's wild. Welcome to the Deep Dive, everyone. Today, we're taking a fascinating look under the hood of commercial real estate in 2026. And to do that, we have a very specific, a very revealing set of sources.
Right. We're looking at the Q1 2026 earnings report and the supplemental information presentation from KKR Real Estate Finance Trust, Inc., or, they usually just go by the ticker symbol KREF.
KREF, yeah. And the mission today is to really decode what a dramatic, what they call a transition year actually looks like for a multi-billion-dollar real estate portfolio.
Because what KREF is doing behind the scenes right now, it tells you exactly how the biggest players are surviving a market that has just fundamentally broken all of its old rules.
Right. And on paper, if you just glance at the top line numbers, it looks like KREF had a totally brutal quarter. I mean, net losses, a slash dividend.
Oh, yeah. Visually, it's rough.
But if you actually look at the mechanics of what they're doing, this massive financial trust is quietly executing a radical pivot.
Mm-hmm.
They're actively taking over properties, they're aggressively writing off bad debt, and leaning into some pretty wild new realities. So, okay, let's unpack this.
Yeah, to understand the pivot, you really have to first understand the pressure cooker they're operating inside, right? We have to look at the pain of the current macro environment and exactly how KREF is bracing for impact before we can even talk about where they're going.
Let's start with those hard numbers then. So in Q1 2026, KREF reported a net loss of 96 cents per diluted share. And their distributable loss, which is, basically the actual cash they generated that can be handed out to shareholders, was 6 cents per share.
Right.
That's a really sharp drop. And because of that shrinking cash flow, they went ahead and cut their dividend down to just 10 cents per share.
And look, for a real estate investment trust, cutting the dividend is a massive, painful signal to the market.
Yeah, because people buy these for the income, right?
Exactly. Investors buy these specific stocks for reliable quarterly income. So dropping that payout to a dime is management bluntly stating that that capital preservation, just surviving the storm, is now priority number one over keeping shareholders instantly gratified.
Makes sense. But then I was looking at their book value per share, the BVPS. It sits at $11.87. Now, normally, a big drop in earnings like we just talked about sparks total panic about the book value collapsing. But there is this massive line item here that changes the whole story, and it involves a lot of financial alphabet soup.
Ah, yeah, you're talking about the CCL allowance.
Yes, exactly.
Right, so that $11.87 book value includes a massive deduction of $4.03 per share for CECL, which stands for Current Expected Credit Losses.
Explain that mechanism for us, because to me, it almost seems like they're preemptively punishing themselves.
Yeah, it does look like that. Think of the CECL reserve like packing the airbags before you hit the wall.
Okay.
They haven't necessarily lost all of that $4.03 per share yet, but accounting rules basically require them to look at their portfolio, look at the struggling commercial real estate market, and legally set aside the money they expect to lose.
Oh, I see.
Yeah, so they actually took a $73.5 million provision for credit losses just this quarter alone to build up that reserve.
So they are actively pulling that money out of their book value today to create this, financial shock absorber.
Exactly.
And when you look at their balance sheet, their defensive posture goes way beyond just accounting reserves. I mean, they're sitting on $653 million in available liquidity.
Which is huge.
Yeah, that includes $135 million in straight cash and $500 million sitting completely undrawn on a corporate revolver.
And we should probably clarify that corporate revolver for a second.
Yeah, go ahead.
Think of it as a massive $500 million corporate credit card provided by a syndicate of banks. KREF hasn't swiped it at all. The balance is zero.
Wow.
But having that massive credit line just sitting there untouched gives them incredible optionality if things get worse.
Plus, the structure of their existing debt is fascinating to me.
Yeah.
They have a $7.2 billion financing capacity, but exactly 0% of their corporate debt is due before 2030.
Right. They have no final facility maturities until 2027.
And here's the stat that really caught my eye, actually. 77% of their secured financing is fully non-mark-to-market. Why is that specific detail so critical right now?
Oh, if we connect this to the bigger picture, that non-mark-to-market stat is basically their armor against the death spiral we are seeing take down other firms.
What do you mean by death spiral?
Well, in real estate finance, if you have a traditional mark-to-market loan and the value of the underlying skyscraper drops by, say, 30%, your lender can hit you with a margin call.
Right. They demand tens of millions in cash immediately to cover that gap in value.
Exactly. And if you don't have the cash,
You are forced to sell the property at a fire sale price just to cover the margin call.
yes,
Which then dumps more cheap real estate onto the market, driving everybody else's property values down even further. It is a terrifying feedback loop.
precisely. It's a nightmare. But because 77% of KREF's secured financing is non-mark-to-market, they are largely immune to that specific trap.
That's incredible.
Yeah, and the remaining balance is marked to credit. That means as long as their borrower is still making the monthly interest payments, a short-term drop in the building's appraised value doesn't trigger a margin call.
So it's like they're weatherproofing a massive house while a Category 5 hurricane is already raging outside. They're taking the hit on the costs now, cutting the dividend, stockpiling cash, just to make sure the foundation survives.
That's exactly.
Because it really buys them the most valuable asset in a crisis, which is time. They aren't forced into fire sales. They get to decide when to sell, when to hold, and when to foreclose.
Time is literally everything here. KREF controls their own timeline precisely because of that liquidity buffer and that specific debt structure.
Okay, so they have packed the airbags and they have the time. Let's look at what is actually hitting the windshield right now. Where are these expected losses coming from? Because this brings us to their loan portfolio and what financial folks ominously call the watch list.
Right, the dreaded watch list. Let's frame the scope of this portfolio first. KREF manages $5.1 billion in loans. It is 100% senior loans.
Which means if a project goes bankrupt, KREF is at the very front of the line to get paid back from whatever is left.
Exactly. And crucially, 99% of this portfolio is floating rate.
And that floating rate is really the hidden engine of this entire crisis, isn't it?
Yeah.
Mechanically, how does that squeeze the borrower?
Well, a floating rate loan means the interest rate changes based on broader economic benchmarks set by the Federal Reserve.
Okay.
Over the last few years, as inflation spiked, rates skyrocketed. So imagine you own a commercial building. It brings in a stable, say, $100,000 a month in rent. A few years ago, your floating rate mortgage payment was $60,000. You're making a healthy profit.
Right.
Today, because rates floated up, your mortgage payment is suddenly $110,000.
Oh, man. So your rent revenue hasn't changed at all, but your debt cost just nearly doubled. You were instantly bleeding cash every single month.
That is the exact mechanism causing the distress across the industry. Now, for KREF as the lender, higher rates technically mean they collect more interest. They report and I'm quoting here, weighted average unlevered all-in yield of 7.2%.
Okay, pause. Translate that jargon for us. What does an unlevered all-in yield of 7.2% actually mean in plain English?
Basically, before you factor in the cost of KREF's own corporate debt, they are earning a 7.2% interest return on the $5.1 billion they lent out.
Okay, so it is a pretty strong return.
It is. And because of that, the overall health of the portfolio looks okay on average. They use a 1 to 5 risk rating scale, with 1 being pristine and 5 being a severe problem. The weighted average across the whole portfolio is 3.3.
The average looks stable, sure, but averages hide the extremes, right?
Yeah.
And the watch list, which is where they stick the troubled loans, is seeing intense, terrifying activity.
Oh, absolutely.
Specifically, the total principal of risk-rated 5 loans ballooned quarter over quarter to $704 million.
That is a massive jump into the absolute highest risk category, and we are seeing specific properties driving this pain.
Like what?
Well, 3 massive loans dropped from a 3 to a 4 just this quarter: a Philadelphia office building, a Georgetown multifamily property, and a Carrollton multifamily property. Plus, a major Boston life science development plummeted straight from a 3 down to a 5.
Yikes. That Boston life science project is a $313 million committed loan, and the presentation notes it is currently in maturity default.
Right.
Meaning the loan term completely ended and the borrower just couldn't pay back the principal or even find anyone willing to refinance it.
Exactly. But amidst all these painful downgrades and defaults, there is this data point in the report that completely challenges the dominant media narrative.
Oh, the repayments.
Yes.
Yes.
KREF actually received $415 million in loan repayments this quarter.
This is the part that completely caught me off guard.
Yeah.
They got $312 million back, specifically from office loans. Everyone, I mean, from Wall Street analysts to local news stations, says the office sector is a toxic wasteland right now.
Right, the office apocalypse.
Yeah. So how on earth are they getting hundreds of millions of dollars repaid in a dead sector?
That requires unpacking a really crucial nuance of commercial real estate. You cannot paint the entire office sector with one brush. The whole apocalypse narrative totally ignores the flight to quality.
The flight to quality, explain that.
If you look at KREF's specific office portfolio, 87% of it is Class A real estate, and 100% of it is L certified.
Okay, meaning these aren't your depressing drop-ceiling cubicle farms from the 1990s. We are talking about top-tier, state-of-the-art buildings with massive amenities, high environmental standards, and prime locations.
Exactly the kind of space that top companies are fighting over. Corporations might be shrinking their overall square footage because of remote work, sure, but the space they do keep, they want it to be spectacular to lure employees back to the desk.
Oh, that makes total sense.
Right. So a generic suburban office park might be entirely unrefinanceable today. But a state-of-the-art Class A building, other lenders are still willing to write loans for those prime assets, which then allows KREF's borrowers to refinance and pay KREF back.
That distinction is huge, but they aren't just relying on borrowers miraculously finding new capital. KREF is also actively restructuring the bad debt themselves.
Very actively, yeah.
There was a fascinating resolution in Cambridge involving another struggling life science loan that hit a risk rating 5. They didn't just kick the can down the road, they completely re-engineered the deal.
They took a very pragmatic approach there. It was a large whole loan that was just suffocating the property. So KREF restructured it into 2 parts. They created a new senior mortgage loan for $63 million.
Okay.
But to get that deal done, they forced the borrower to inject some fresh cash to pay down the principal. That new, smaller loan is now considered healthy. They actually upgraded it back to a 3.
Right, but to make the math work on that new $63 million loan, somebody had to take a massive loss.
Oh, for sure.
KREF held a $17 million subordinated note on that property, and they just completely wrote it off, deemed it uncollectible in March 2026. Explain the mechanics of that. Why just delete $17 million?
It all comes down to the capital stack. Think of real estate finance like a Jenga tower.
Okay, I like that.
The senior loan is at the very top. It's the safest. The subordinated note is further down in the stack. If the underlying property loses value, the subordinated note gets crushed first to protect the senior loan.
Got it.
KREF realized that holding onto the fantasy of getting that $17 million back was paralyzing the entire asset. By legally deleting it, they cleansed their balance sheet, stabilized the remaining $63 million loan, and moved forward.
Ripping the Band-Aid off. But that raises a massive problem. Writing off a subordinated note works if the borrower is still willing to play ball. What happens to the loans where the borrower doesn't negotiate?
That's the real issue.
Like what happens to that $313 million Boston Life Science building that just hit maturity default? Well, KREF takes the keys. And this transforms them from a spreadsheet lender into a very real physical landlord.
Yes, and this introduces us to the real estate owned, or REO, portion of the portfolio. When a borrower completely fails, KREF forecloses. They take physical possession of the concrete, the steel, and the leaky faucets.
And this REO portfolio is growing incredibly fast. It is currently sitting at $515 million. And once they finish the foreclosure process on that Boston Life Science loan in Q2 of 2026, the REO portfolio is projected to hit $642 million.
It's a huge jump.
And when you look at the actual list of properties they now own, it is a wonderfully chaotic mix.
It really is a massive departure from their core business. I mean, you have a Seattle life science building where KREF's investment basis is $610 per square foot. You have a sprawling retail redevelopment project in Portland, Oregon.
And my absolute favorite, luxury condominiums in West Hollywood, California.
Oh, yes.
A mega lender now owns 37 physical condo units at an investment basis of $2.6 million per unit. Here's where it gets really interesting for me.
Yeah.
They started the year as a financial trust, issuing senior loans from a boardroom, right? And now they're suddenly the landlords for West Hollywood luxury condos, dealing with HOA fees and trying to figure out how to lease retail space in Portland.
It's wild.
It's like lending your car to a friend. They default on the gas money, and suddenly you are forced to run an Uber fleet.
The Uber Slate analogy is perfect because it highlights the absurdity of the situation, but we also have to look at the underlying strategy.
Right.
They don't want to run the fleet, they want to fix the cars and sell them. KREF does not want to be a long-term property manager for West Hollywood condos.
The strategy is stabilization. Right.
That is the absolute core of their strategy. What's fascinating here is they take the keys because the previous owner ran out of capital or competence. KREF steps in with that massive $500 million liquidity buffer we talked about earlier.
The credit card?
Exactly. They use their own cash to finish the construction, hire the brokers, lease up the empty space, and transform a distressed, defaulting asset into a stabilized, income-producing property.
And once the property is healthy and generating rent, its value goes up, and KREF will sell it into the market to recoup their original loan amount.
Precisely, which perfectly explains the crown jewel of their entire REO portfolio.
Oh, this is the best part.
They foreclosed on a Class A office campus in Mountain View, California. It's a massive 449,000 square foot property. KREF has about $123 million of equity tied up in it, and they just successfully leased it to OpenAI.
I mean, securing OpenAI is the ultimate stabilization play. You take a distressed, defaulting office park, and you secure the most hyped, cash-rich technology company in the entire world as your sole tenant.
That's brilliant.
The physical value of that property just skyrocketed compared to when it was sitting empty in default.
Oh, without a doubt.
So we see the mess of the legacy loans caused by floating rates. We see them aggressively taking over properties to fix them up and sell them. But what is the actual destination here? How does KREF get out of this alive?
Well, this brings us to what CEO Matt Salem explicitly calls the pivot.
The pivot. Management has declared 2026 a transition year, and they laid out an aggressive master plan to completely overhaul the DNA of this portfolio by December.
Right. They set 3 massive targets for year-end 2026. Target 1, reduce their legacy office exposure to under 10% of the total portfolio. Target 2, have approximately 50% of the entire portfolio be brand new originations.
Meaning fresh loans written between 2024 and 2026 under much better economic terms.
Exactly. And target 3, get that terrifying watch list to roughly 0%.
0%. And we are already seeing the evidence of this pivot in real time, right? While they are fighting multi-million-dollar fires in the office sector, they are quietly deploying fresh capital into incredibly safe, boring loans.
Yes, very boring. For example, the presentation details a newly originated $184 million floating rate senior loan.
But it's not for a shiny high-rise office in Chicago. It's for an industrial portfolio in the United Kingdom.
Right, 34 industrial properties.
Right.
Warehouses, logistics centers, distribution hubs, literally the unglamorous lifeblood of the modern e-commerce supply chain.
It's essential infrastructure.
Exactly. And the loan to value, or LTV, on that deal is 72%.
And just to clarify LTV for you listening, if the loan covers 72% of the property's value, that means the overall property value would have to plummet by nearly 30% before KREF's principal is even at risk.
Which is a very thick cushion.
A very conservative cushion. And it earns a coupon of 2.6% over the benchmark rate, meaning whatever the baseline interest rate is in the UK, KREF charges an extra 2.6% on top of it for profit.
It's not a flashy deal, but it is reliable income-generating debt.
Right. After the chaos of Boston life science defaults and West Hollywood condos, they are craving boring. Industrial and multifamily properties now make up 63% of their entire loan portfolio.
Which is a massive shift.
But I have to push back on that timeline they set. They want the watch list at virtually 0% by the end of 2026. That is just months away from this Q1 report. With that massive Boston life science default and those huge Chicago office loans still sitting there at risk rating 4, is getting to 0 actually realistic? Or is this just a rosy picture painted to keep the shareholders from rioting after the dividend cut?
It is a very fair challenge. Getting to absolute 0 in a portfolio this large is incredibly difficult. However, look at the behavioral evidence of management. Look back at that $17 million Cambridge write-off.
Right. They just deleted it.
They didn't extend the loan, cross their fingers, and hope the market magically recovered. They took the financial hit immediately. They literally ripped the Band-Aid off.
Yeah, and you can see that confidence in their capital allocation, too. The board of directors just authorized a new modified repurchase program for up to $75 million of their own common and preferred stock.
A stock buyback is the ultimate signal of internal confidence. They're taking their precious cash and buying their own shares because they mathematically believe the stock is undervalued by the public market. They actually already bought back 92,000 shares in January at $8.25 a share.
If management secretly believed the watch list was a ticking time bomb that was going to bankrupt the trust, they would hoard every single penny. They wouldn't be buying their own stock.
Exactly. The combination of aggressively writing off bad debt, pivoting the new money to industrial loans, and buying back their own stock suggests they have a highly realistic, albeit painful, roadmap to clear out the legacy rot by the end of the year.
So what does this all mean if you step back from the spreadsheets, the LTVs, and the capital stacks?
Mhm.
What is the big takeaway from KREF's first quarter, and why should you, the listener, even care about this?
I think the main takeaway is that KRDF is utilizing a highly structured liquidity buffer to absorb the pain of bad bets made in a completely different economic era.
Yeah.
They are not waiting for the Federal Reserve to rescue them with rate cuts. They are actively foreclosing, taking over the physical real estate to stabilize it themselves, and simultaneously pivoting their fresh capital toward much safer industrial assets.
It really is a real-time playbook for how big money is navigating this commercial real estate crisis. You take the pain early, you grab the underlying assets before they physically degrade, and you pivot your new money into the boring stuff that actually works.
Right.
And this matters to all of us because these massive portfolio shifts dictate the physical reality of our cities. It dictates whether a downtown office building gets renovated or rots, which impacts local property taxes, which impacts municipal budgets. It's Wall Street math, but it has very real Main Street consequences.
And as we look at how they are managing those consequences, specifically by taking over these properties, it leaves us with a fascinating, almost unsettling question to ponder about the future of our cities.
Ooh, what's that?
Well, think about that Mountain View property.
The one they took over and leased to OpenAI.
Exactly. What happens to the broader commercial real estate market if major financial institutions successfully establish a floor on collapsing property values by converting their bad debt into equity and then exclusively leasing those stabilized properties to the world's most cash-rich tech titans?
Oh, wow. That changes the whole ecosystem.
Right. Does the long-predicted commercial real estate apocalypse actually happen? Or does the landscape just get quietly, exclusively gentrified by mega lenders and AI companies, locking smaller businesses and everyday people out of prime commercial real estate entirely?
That is a massive thought to chew on. The apocalypse might just be an exclusive renovation, and most of us simply aren't on the guest list. Thank you for joining us on this deep dive. We'll catch you next time.